Welcome back to the channel. Today we are analyzing one of the most dramatic market events in recent financial history, the historic crash in precious metals markets that sent shockwaves through global trading floors. Gold experienced its steepest decline in over 4 decades, while silver recorded an unprecedented intraday collapse that has analysts and investors reassessing their strategies. In this analysis, we will break down what happened, why it happened, and what this means for investors moving forward. Whether you are a seasoned trader or just beginning to understand financial markets, this event offers critical lessons about market dynamics, risk management, and the complex interplay between monetary policy and commodity prices. This content is for educational purposes only and should not be considered financial advice. Always consult with a qualified financial advisor before making investment decisions. The market event. What happened? Let us start with the facts. On this particular trading day, precious metals markets experienced extraordinary volatility that caught even experienced traders by surprise. Gold prices plummeted more than 12% in a single session, dropping below the psychologically significant level of $5,000 per ounce. This represented the largest intraday decline for gold since the early 1980s, a period marked by extreme inflation and aggressive Federal Reserve policy. Silver faced an even more dramatic sell-off, tumbling as much as 36% during intraday trading. This marked a record decline for the metal and highlighted the amplified volatility that silver often exhibits compared to gold. The silver market, being smaller and more susceptible to rapid price swings, magnified the broader precious metals sell-off. The contagion spread beyond precious metals. Copper, which had recently reached all-time highs in London trading, declined 3.4% from those peaks. Base metals showed weakness across the board, suggesting a broader reassessment of commodity valuations. Currency markets also experienced significant movement. The US dollar surged against commodity-linked currencies, with both the Australian dollar and Swedish krona coming under pressure. This currency dynamic played a crucial role in the precious metals sell-off, as we will explore shortly. Market context: the rally before the fall. To understand this crash, we need to examine what preceded it. Over the preceding year, precious metals had experienced remarkable demand that pushed prices to unprecedented levels. This was not typical market behavior driven by gradual accumulation. Instead, multiple powerful forces converged to create what some analysts described as a perfect storm for gold and silver. First, concerns about currency depreciation drove investors toward traditional safe haven assets. When confidence in fiat currencies wavers, precious metals typically benefit as alternative stores of value. This dynamic intensified in January as multiple worries crystallized simultaneously. Second, questions arose regarding central bank independence, particularly concerning the Federal Reserve. Any perception that monetary policy might be subject to political influence tends to increase demand for assets that sit outside the traditional financial system. Third, escalating trade tensions created economic uncertainty. Trade disputes between major economies introduce unpredictability that often benefits defensive assets like gold. Investors seeking portfolio protection flocked to precious metals as a hedge against potential economic disruption. Fourth, ongoing geopolitical instability provided additional support for gold prices. Whether regional conflicts or broader international tensions, geopolitical risk typically supports precious metals demand, as investors seek security. This combination of factors created exceptional buying pressure. Investor demand reached record levels, with both institutional and retail participants accumulating positions. The intensity and speed of the rally surprised even seasoned precious metals traders, creating price volatility that would ultimately contribute to the subsequent reversal. The catalyst: Federal Reserve nomination. Every major market reversal has a catalyst, and in this case, it came from Washington. Reports emerged that the Trump administration was preparing to nominate Kevin Warsh as the next chair of the Federal Reserve. This news, subsequently confirmed, triggered the dollar rally that precipitated the precious metals sell-off. Understanding why this nomination mattered requires examining Warsh's policy reputation. Among the candidates being considered for Fed chair, Warsh was widely viewed as the most hawkish on inflation. This characterization suggested he would likely favor tighter monetary policy and be less accommodative than alternatives. For precious metals markets, this had immediate implications. A more hawkish Federal Reserve typically means higher interest rates and a stronger dollar. Both of these outcomes work against gold and silver prices. Higher interest rates increase the opportunity cost of holding non-yielding assets like precious metals, while a stronger dollar makes dollar-denominated commodities more expensive for international buyers and less attractive as inflation hedges. The market reaction was swift and brutal. Investors who had piled into precious metals on expectations of continued dollar weakness suddenly faced a reversal of that thesis. The dollar surged, and with it came selling pressure in gold and silver markets. According to Akash Doshi, global head of gold and metal strategy at State Street Investment Management, the announcement represented a clear positive for the U.S. dollar and a negative for precious metals. This assessment captured the immediate market interpretation. The policy environment that had supported the precious metals rally was potentially shifting. Market dynamics. Why the crash was so severe? The severity of this sell-off requires deeper analysis. Market crashes of this magnitude rarely occur from a single news event alone. Instead, they typically result from a combination of positioning, leverage, liquidity conditions, and the unwinding of crowded trades. First, consider the positioning dynamic. The preceding rally had attracted massive investor interest, creating what traders call a crowded trade. When many market participants hold similar positions, the potential for disorderly exits increases dramatically. As prices began falling, stop-loss orders were triggered, creating additional selling pressure that fed on itself. Second, leverage amplified the moves. Many investors had used leverage to amplify their precious metals exposure, betting that the rally would continue. When prices reversed, these leveraged positions faced margin calls, forcing liquidation regardless of long-term views. This created a cascade of selling that overwhelmed available buying interest. Third, silver demonstrated why smaller markets face amplified volatility. With lower trading volumes and less liquidity than gold, silver prices can swing more dramatically on equivalent selling pressure. The 36% intraday decline reflected this structural characteristic of the silver market. Fourth, the dollar strength created a double impact. Not only did a stronger dollar make precious metals less attractive, but it also pressured commodity currencies like the Australian dollar and Swedish krona. These currencies have economies linked to commodity production and trade, so their weakness reinforced the broader commodity sell-off. The combination of these factors created what market veterans call capitulation, a period where sellers overwhelm buyers and prices fall rapidly until reaching levels where new buyers emerge. The fact that this sell-off exceeded even the October decline demonstrated just how much the market narrative had shifted. Investment implications and lessons. What should investors take away from this event? Several important lessons emerge from analyzing this market episode. Lesson 1. Policy changes drive markets. The immediate trigger for this sell-off was policy-related news. Central bank decisions and leadership matter enormously for asset prices. Investors need to stay informed about policy developments and understand how different policy stances affect various asset classes. Lesson 2. Crowded trades carry risk. When everyone rushes into the same trade, exit risk increases exponentially. Diversification is not just about holding different assets. It is about avoiding excessive concentration in popular trades that might reverse suddenly. Lesson 3. Leverage magnifies both gains and losses. While leverage can amplify returns during favorable market moves, it dramatically increases risk during reversals. The forced liquidations during this sell-off demonstrate why prudent position sizing matters more than maximizing potential gains. Lesson 4. Safe havens are not always safe. Gold and silver are often considered safe haven assets, but this event reminds us that no asset is immune to selling pressure. Understanding what drives an asset's price is crucial before relying on it for portfolio protection. Lesson 5. Currency relationships matter. The inverse relationship between the dollar and precious metals proved decisive in this sell-off. Investors need to understand how currency movements affect their holdings, particularly in commodity markets where most trading occurs in US dollars. Looking forward, this event does not necessarily mean precious metals have lost their role as portfolio diversifiers or inflation hedges. Rather, it demonstrates that all assets respond to changing fundamentals, and no single narrative drives prices indefinitely. Conclusion: the historic precious metals crash represents a significant market event with important lessons for investors at all levels. Gold's largest decline in 40 years and silver's record intraday drop serve as powerful reminders of market volatility and the importance of risk management. The catalyst, a shift in Federal Reserve leadership expectations, demonstrates how policy changes can rapidly alter market dynamics. The severity of the sell-off highlights the dangers of crowded trades, excessive leverage, and insufficient diversification. For investors, the key takeaway is the importance of understanding what drives asset prices and maintaining appropriate risk controls. No asset class is immune to volatility, and even traditional safe havens can experience dramatic price swings when underlying conditions change. As always, successful investing requires education, discipline, and a clear understanding of your own risk tolerance and investment objectives. Events like this precious metals crash provide valuable learning opportunities if we take time to analyze what happened and why. Thank you for watching this analysis. If you found this content valuable, please like, subscribe, and share your thoughts in the comments below. What lessons do you take from this market event? How do you approach risk management in your own portfolio? The discussion and different perspectives from our community always add tremendous